Welcome to the B.F. Anderson Technical Report for July the 14th. I want to start out with a quote by Gerald Loeb, who wrote a book in 1935 called The Battle for Investment Survival. Now think about the title, The Battle for Investment Survival, book written in 1935. Market peaked in 1929. Great Depression starts. Now what caused it? It was too much debt. The debt was the culprit. And what Loeb was able to do as a partner of E.F. Hutton was to evaluate tens of thousands of brokerage accounts to determine who survived the 1929 bear market. Now realize the market peaked in 29, then bottomed in 1933, and then really didn't turn up till about 1942. But the quote goes this way: obviously, our ideas will sound wrong to most people. Any investment policy followed by all naturally defeats itself. Thus, the first step for the individual really trying to secure or preserve capital is to detach himself from the crowd. Now, what he's saying there is that there is no investment strategy that's going to work all the time. And the reason being is that if there was such a thing, everybody would do it, and then it wouldn't work. So it's a valuable quote, and detaching oneself from the crowd simply means that big is bad, small is good. You want to be the small investor has a tremendous advantage over these large financial institutions. So I want to get back into the charts here. And I apologize for continuing to bring this chart up week after week, but the correlations between where we are today and 1983 are too many to ignore. Now remember, the market went through an extreme consolidation period here between 1998 and roughly 2013, 2014. You know, it did start to recover in 2009, but it really didn't break out to new highs until about 2013. So we're talking about a very lengthy period of time. Plus, this drop here really does somewhat resemble the 1929 drop, but the difference being is that the banking system survived because of the TARP program. You know, Ben Bernanke and Paulson, that were in government at the time of this, we really need to take our hat off to them, because the TARP program did save the banking system. You know, Bernanke was head of the Federal Reserve at the time, was basically, he was writing textbooks for, economic textbooks for colleges to use, and his primary thesis in these textbooks was to go back and study the 1929 Depression and do things to keep that from happening again. So they have successfully saved the banking system, and it sure was looking kind of bleak in here. So what you have to realize was happening back in 98 was the economy was going bad. Recessions, government bailouts, more recessions, financial collapse. So what happened here was the economy just gradually got worse and worse and worse and worse. Well, that can change. And so if we go back and realize that this type of move has only happened two other times in history, which was 1929 to 1954. Then you go back here and realize that this happened between 1966 and 1983. So just using common sense, you just basically realize that most people over a lengthy period of time like this really grow to hate the stock market. And in the nicest way I can say it, it's a good thing, because that means that people are doing other things with their money, which means that there's a lot of fuel out there that if this thing does get going again, like it did in 83, well, that's a lot of money to come into the market, and that's a lot of fuel. Now, we've talked in the past about these consolidation periods as you go. Now remember, point A, point B. Point A is the Dow broke out at 1,000. Point B, it peaked at around 12,000. So what's interesting here is that, yes, if you would have been in the Dow stocks, you would have made 12 times your money. But if you were a focused investor, you would have been focusing on things like the PC development, Intel, Microsoft. Then you would have gotten into the 90s. You would have been focusing on the internet stocks, things like Cisco Systems, Amazon, Yahoo, America Online. And so you would have made a heck of a lot more money than 12 times your money if you were a focused investor. Now, what we need to understand that what was driving this move was the fact that the economy gradually got better. So here's a new correlation. The GDP growth rate in 1983 was 1.4%. By the time the economy peaked here, it was at 6%. Right now, as of today, we are at a GDP growth rate of 1.4%. So are we going to 6%? I don't know. But the Trump administration's talking 3% if they can get the tax cuts through. So what we want to do is be aware of what we call the weight of evidence. There's two concepts out there. One, you have facts. We know what facts are. These are things that have actually happened. But the weight of evidence is a way to to try to determine what the facts are going to be. So is the economy improving? Well, let's look at some facts. One of the facts out there is the fact that corporate earnings are improving dramatically. In the first quarter of this year, corporate earnings improved the most in years. I mean, if you go back and look at this, I mean, we did have a recovery going on back here in 14, which peaked out around 15, but, corporate earnings have been just doing nothing but declining. Well, if you look at what's going on recently as of first, second quarter, earnings are improving dramatically. So that's one thing to look at. I think another thing that's kind of important is the fact that the transportation index, the Dow Jones Transportation Index, we're talking trains, boats, ships, airplanes, anything that's moving goods and services. This index is hitting all-time new highs after going through a tremendous consolidation period along with the market. You got your crouch and now you're getting your leap, making new highs. So there's another check on a box that we could use to determine, is the economy getting better? Now, one of the things I've always promoted is to keep an eye on the 10-year Treasury note. Now, realize back here in August or July, August of last year, we saw the 10-year Treasury get down to 1.3%. Now, realize that's the lowest interest rate on the 10-year Treasury in history. The lowest it ever got back in 1933 was 2%. So interest rates are a barometer of economic activity because it's just like anything, supply and demand. If demand for credit is high and there's a lot of activity going on out there, interest rates move higher. So as you can see, pretty much since the election, there's been a major up move in interest rates, and we're seeing a breakout above the downtrend that basically got started back in March. Now, a breakout above 2.6 would really be an indication that things are heating up. But the good news, I think, also was Chairman Yellen recently was making her talk to the Congress, and she said simply that inflation is under control. Inflation can be a major culprit. Now, that's another check on the box. Okay, let's take another look at another thing. This is the financial sector. This is the banks and insurance companies. Again, just recently made an all-time new high. So it looks like the financial sector is healthy. There's another check. Now, here is a bond fund. This is a 20-year Treasury bond fund. Again, you've got a downtrend line going here. The bond fund did challenge that downtrend line, but has now come back down again because interest rates are starting to climb. Interest rates go up, bonds go down. Now, just think about this for a minute. I could show you gold. I could show you all kinds of defensive type of assets, but bonds are going down, interest rates are going up, transportations are hitting new highs, corporate earnings are improving. Now, let's take another look, and we can check that box, by the way. Toll Brothers. This is a home construction company. They build houses. It just recently hit a new high. Now, I think the economy is recovering. So let's look at the top five. Top five this week, Alibaba. It's interesting about China, and it's interesting about this company. There's a gentleman that runs this company named Jack Ma. There's lots of books written about him. I'd recommend you read about this guy and learn about him. He was a school teacher. His favorite movie is Forrest Gump. And he always likes to say, life is like a box of chocolates. You don't know what you're going to get. So Alibaba is the Amazon of China. Well, I'm going to even say it's the Amazon of Asia. So if you think about it for a minute, and this is what Jack Ma said in a recent interview, he is of the opinion that the middle class in China is going to double in size by the year 2020. So if you're thinking about an Amazon e-commerce type of thing, I really think you ought to be taking a look at Alibaba. Number 2 on the list was, again, NVIDIA. NVIDIA has come back very strongly here. We're talking artificial intelligence. We're talking major technology. Keep an eye on NVIDIA. Also, Shopify, a little sloppy. We've got a crossing here of the moving average. The stock has pretty much gone into a consolidation mode, I believe primarily because they did a secondary offering at $91 a share where they raised $500 million. And I think what the market's waiting on here is more information as to what they're going to do with that $500 million. Personally, I think they're going to make some acquisitions. Now, the next one is Square. Now, this is a new name on the top 5. Now, this is a financial service company. Now, we've all seen the little gadgets that stick into an iPhone. And by the way, Jack Ma on Alibaba did state that he thought the biggest breakthrough in the Chinese economy was the use of the mobile phone. Who would have thought? Anyway, Square is use of the mobile phone, where you can turn your mobile phone into a cash register, basically. Stock is broken out, making all-time new highs. Realize this company just went public 2 years ago. This is pretty fresh. And the same is true for Alibaba. It went public about 2 years ago. Now, last but not least, we've got a biotech still making the top 5. This is Vertex Pharmaceuticals, continues to be in an uptrend. So in conclusion, it does look like the economy is improving. This does look like 1983, and I hope I'm right. So if you have any questions, let me know.